This is the ninth video of the series Security Analysis for Investments, and in today's video we are going to see another method of DCF methodology of valuation, which is the dividend discount model. And previously we have discussed FCFE and FCFF, and now we are discussing dividend discount model. But this model is simpler compared to the other two models, and it is easy to understand because already we have discussed the theory part in the FCFE calculations. So most of the things will repeat itself, and we don't have to explain it once again here. So let us start. So the primary premise of free cash flow here is that the cash flow distributable, that means free, is only the dividend. That means whatever is paid by the company in terms of dividend to its shareholders is the only free to distribute cash flow. And this means two types of dividends can be there. One is the present means the recent payments of dividends, and the expected future payments, future dividends, which we don't know. So we must need to forecast the expected payment of the dividends. And once we have found both of these, both the present and the expected, so from there we will calculate a present value. That means the value in terms of today's time, the present value of the dividends, that will be the value of the asset in this case. So remember again that any other kind of cash flow you are not considering, you are only considering the dividends payments. So that's it. So let us now see the calculation. The calculation is very similar to the FCFE calculation. First of all, there will be a G1, that means a high growth period, where there will be an extraordinary growth rate. And how to calculate that? First of all, we will calculate the ROE, that means return on equity, by dividing net income by the shareholders equity, and we will do this for 2 years, 2 consecutive years, and take the average, exactly same as the FCFE calculations. So if you have not seen the FCFE video, I'll post the link here. Make sure that you check that video, because these theory parts we have already covered, so I am not covering it again here. So why this is for 2 years and average, and then what is retention ratio, and all these things are explained in that video. So it is just a repetition here, we just have to use all those figures here also. So this is again the retention ratio we have to calculate, 1 minus DPS and EPS, DPS divided by EPS. So what is this DPS 0? DPS 0 is the dividend per share in today's terms, means what is being paid in terms of dividend per share today or in the most recent year, and similarly for the earning per share also. And what is G1? G1 is the ROE only, but factored in terms of the retention ratio. This means whatever is retained, not paid in terms of dividend. So whatever is retained is here. This is the factor, and we will factor the ROE in terms of retention ratio. That will be our G1. And what will be our G2? It is completely discretionary and customary to use a figure of 6% to 7%. We will use 6%, as we have used already in FCFE and FCFF, right? So from there we will calculate the retention ratio of the stable period. So we will just take the reciprocal of this. That means if you just write this one in terms of G2 will be ROE into RR of stable period, and from here RR of stable period is equal to G2 by ROE, right? ROE of stable period, of course. So this is what is written here. So we will calculate this. Then after that, how to project, how to forecast. For example, in case of high growth period, we will first of all start with the current year's dividend, that is DPS 0. Of course, we will multiply it in by 1 plus T, which is the marginal tax rate. Then we will project by increasing it by G1 in every year. That means DPS 0 into 1 plus T plus into 1 plus G1. That will be, this is your 0 year, this is your first year, second year, and so on. So this is 1 plus G1, this is 1 plus G1 to the power of 2, and so on. So 3, this 3 and 4 are here, and then this is year 5. So dp is 0 into 1 plus t into 1 plus g1 to the power 5. Hope this is very clear. There is no confusion about this. Then we will, once this is calculated, we will take the net present value of the entire cash flow. That means the entire terms. These terms will be calculated, and then we will take the net present value of that. That will be the net present value for the high growth period. And for the stable period, what is to be done? See, we don't know what will be the dividend in the stable period. So as I was telling you, some dividends in today's terms, we know it is DPS 0. You can forecast it up to year 5 by using the G1 growth rate. But we are not sure about the dividend that will be paid after this stable period. So we will indirectly calculate that dividend or the terminal value of that using the EPS methodology. So what is that? So first of all, we will note the EPS 0 value, that means the earning per share of the most recent year. Then we will project the earning per share again in the similar manner up to year 5. So this is year 0, this is year 1, year 2, this is 3, 4, and this is again year 5, exactly similar to this. And please remember, while projecting the EPS, we are not using the G2 growth rate. We will again use the G1 growth rate. But when we'll project it in the 6th year, that means from 5 to 6, year 5 to year 6, then we will use the EPS 5 value. That means what is EPS 5? This is your EPS 5 value. EPS 5 value, then only we will use the G2 figure. So from year 5 to year 6, we will use the the stable growth rate, that means G2. So that way we will calculate the EPS 6. So this is your EPS 6. So once this is calculated, that means the EPS 6 is calculated. Calculate the DPS 6. This will be EPS 6 here, using the RR stable period. So remember, we have calculated the RR stable period using, I have explained this in the earlier slide. So using that value, and from this EPS 6, we will indirectly calculate the DPS 6. And once this DPS 6 is calculated, we can calculate the terminal value of all the DPS in the future by using this formula. This is again the deduction of infinite geometric progression, GP, basically infinite annuity formula you can learn in any finance book. So using that, we will calculate the terminal value. And once this is found, that means this terminal value, suppose this is 2 and suppose this is 1. Once these two are found, then we just have to, first of all, we need to take this terminal value to the present value, that means this one, and then just add these two, that means this NPV and this present value of the terminal value. Once we add these two, we will get the value of the asset in terms of dividend discount model. So now I hope this is clear, and little bit confusion may be there, so that will be removed once we will go and see the calculation exactly in the same manner using a spreadsheet. So let us come to the spreadsheet to complete the process. Now Okay, so here is the spreadsheet. We will implement the model. So first of all, note that there is entry for average ROE for the growth phase, and we don't need to calculate this once again because we have already computed in FCFE. So in FCFE, you can see here the average ROE was 22.13%. So we will take that figure only. Then the current EPS for the most recent year, that is also there in the FCFE sheet. So this one 27.01. So we will directly take it from the FCFE sheet 27.01. Then extraordinary growth period. We have already told you that in FCFE and FCFF we have taken 5 years. So in this case also we are taking 5 years. So basically for the next 5 years there will be extraordinary growth or high growth, and then after that the growth will cease and there will be a stable kind of situation, stable growth. And what is the stable growth rate? I have told you that it can be 6% or 7% as it is written here. So in our case we have assumed 6% because in both FCFE and FCFA we have assumed 6%. So we will maintain the same continuity, 6%. And what is the present DPS? That is also there in the FCFE sheet, so 2.46. We'll take the same value here. Then what is dividend payout ratio? Please note, payout ratio is nothing but the supplement of retention ratio. That means this is payout ratio is DPS divided by EPS. And therefore, what is RR? We have already defined RR is 1 minus payout ratio, right? So we need to, you may directly calculate RR also or payout ratio also. So I am taking payout ratio here. So DPS 0 divided by EPS 0. So this is 9.11% is our dividend payout ratio. So what is the extraordinary growth rate? And this is G1. G1 is our extraordinary growth rate. We have defined that this will be ROE into retention ratio. So what is the ROE? ROE is this one into retention ratio. That means into 1 minus payout ratio, right? So basically this is equal to ROE into 1 minus payout ratio because of this. So KEAG, what is KEAG? It is the cost of equity in the high growth period. So we do not need to calculate this. We have already computed this in the weighted average cost of capital worksheet, 13.8%. So we will take the same figure. And in FCFE, I have told you that the stable period growth rate, or sorry, the stable period cost of equity is going to be the same calculation, only the beta figure will be little less. So it will be equal to 1 or 1.05, something like that. So we will take 1.05 beta and then note this value 12.2%. So that will be our cost of equity in the stable growth period. And what is ROE? See, in the FCFE calculation also, we have calculated ROE as cost of equity plus delta, a small percentage, 0.25%. So same notion of calculation we will take here plus 0.25%. So this will be our ROE for the stable phase. Now what is the retention ratio of the stable period? We have already given you this particular expression. So this is G2 by ROE of the stable period. So what is G2? So this is G2 divided by ROE for the stable period. So average ROE for the stable phase is 12%. So this is your stable period retention ratio. Right. So now we will project the DPS. So these are the year numbers, 5 years. So note these calculations here. I will delete these markings. So let me delete these markings only. Okay, this is enough. So now this is your 0 period DPS. Then this is year 1 DPS. This is year 2 DPS. So this is starting right from year 1. And what is your year 0? Year 0 is DPS 0 into 1 plus T. So what is your year 1? Year 1 is DPS 0 into 1 plus T into 1 plus G1. So let us write that DPS 0 into 1 plus T. Now what is T? In our beta worksheet, we have taken marginal tax rate as 22%. So we will take the same value, that is 0.22. So this is DPS 0 into 1 plus T into 1 plus G1. What is G1? This is extraordinary growth rate. So G1 is this one. So we will calculate this. So this DPS will remain constant and growth rate will also remain constant. So we fixed this using these dollar signs, and then we will just copy them to the right, and there is a mistake, we have to take to the power of year number, right? So in year 1 this will be 1 plus G to the power of 1, then year 2 to the power of 2, and so on. So this one is like this, and then we will take the NPV. So NPV of what is the rate in this case? We will not take the weighted average cost of capital, rather we will take the high growth periods cost of equity. So this one, and then these are the cash flows, right? So this is our NPV. PV for the dividend. Now we need to find the terminal value. That means the stable period calculation. So for that, again I will write the year numbers here, and then I will project the EPS. So the 0 period EPS is EPS 0. Year 1 is this one, EPS 0 into 1 plus G. Year 2 is this one. So this is again to the power of 1. So I will calculate this like this is EPS 0 into 1 plus G1 to the power of year number. Now I will project this up to year 5. But then in year 6, I will not project. I will rather use this particular expression. So this will be my EPS 6. This will be my EPS 6. EPS 6. So what is that? That is EPS 5 into 1 plus G2. This time it is the stable period growth rate. So 6%. Right? So now this is the EPS. This is the EPS 6. So we have seen how to find the DPS 6 using EPS 6 using this particular expression. So let us implement that. So EPS 6 into 1 minus RR of the stable period, which is this one, into 1 plus T, right? So this is your DPS 6. Now we need to calculate the terminal value for the 5th year using this DPS 6, and this is your formulation. So we have to change a little bit this formula. This is not correct, incorrect. So the correct formula is DPS 6 divided by K minus G2. So first of all, This has to be G2 because this is the stable period growth rate, and we are calculating this for the stable period. So this cannot be G1 plus this. If you subtract K from G2, that will be a negative number. So that cannot be true. Basically, this will be K minus G2. So let us implement this here. So this is DPS 6 divided by K. What is the K? K is the stable period cost of equity. This minus G2, right? So this is your terminal value for the 50th year. Now you have to take this to the present value. So for that we will take this terminal value divided by 1 plus our cost of equity for the high growth period to the power 5. So this will give me the present value of this terminal value, and now finally this plus this should give me the intrinsic value based on the dividend discount model. Now this is the complete calculation for dividend discount model. Hope you have understood this well. If not, then please go through this video 1 or 2 times so that you can understand. So we have covered 3 models: FCFE, FCFF and DDM. In FCFE our intrinsic value found was 450, in FCFF it was 611, and in DDM it was 399. So 3 methods, 3 figures. That is not a matter of surprise because 3 methods have their 3 assumptions. So you may take an average of these 3 numbers if you want. So anyway, this is the dividend discount model, and in the next video we'll discuss another method, completely different method, which is not a DCF based method. And but until then, goodbye and thanks for watching this video.